In the world of fintech companies, we are at a tipping point right now between dying legacy banks and new fintech companies that is on the forefront of innovation and trying to go after what the consumer really wants. Now, the word fintech spans across a lot of different avenues, from peer-to-peer networks to digital banking to trading platforms. But in my eyes, right now, we are primed for 5 very exciting companies that could do amazingly in the years to come. So whether you're a casual investor or a financial professional, you better know about these companies because they're making waves in the industry. First up, we have Block Incorporated, ticker symbol SQ. Now, Block has about 5 or 6 different great companies that they have working underneath them, but most specifically are 2 main companies that we're going to be focusing on today, Cash App and Square. And as of the time of recording this video, Cash App has brought in 49 million active users, which is up 20% year over year. So although they have a big active amount of users, they're still growing very quickly. Now, the most interesting part about Cash App in general is their customer acquisition cost, which is just roughly about $10 per customer. This is by far their biggest moat and what's allowing them to grow at such low cost compared to any other banking institution or fintech out there. They're able to achieve this because their app is simply cool, right? So their app is actually spreading through virality, whether that's through word of mouth or being the highest app on the actual app store whenever it comes to financial companies. So although the revenue per user is still small at Cash App, they've actually been able to 6x the return on investment for each individual customer because of the new product lines that they're starting to branch out into. So with things now like the Cash App card and Cash App Pay, it has really increased the amount of activity that per customer is actually using, and that's actually increasing the ROI per customer by great lengths. As of the last quarter, Cash App's revenue was $817 million, which is actually up 41% or a 73% 3-year compounded annual growth rate. If you don't know anything about compounded annual growth rates, numbers start to get absolutely out of hand the faster you can actually keep up those rates. So it's absolutely stunning that they're able to keep up this high of an actual activity rate on their new Cash App company, and it doesn't seem to be slowing down as year after year it continues to be on the top of the list. But now on to Square, where their ecosystem is just as beautiful. Providing a range of financial services and payment solutions to businesses of all sizes, some of their biggest products for a, point of sale terminal customer, like the example that I was using previously, could be to actually take that business and turn it into an omni-channel business where they might have an online section as well. And then they can start to get into things like invoicing, payrolls, or even lending services, all which increase the total average revenue per that individual client. Now, unlike Cash App, which is just US based, Square sticks out because they are going absolutely international. So this international growth, coupled with the multi-product stickiness that they are doing just like Cash App, is what's leading these clients to, once they get on the platform, they never leave. And even whenever you look at the cohorts that have gone, previously, they are all growing, which is leading to this multi-compounding business and going after new customers. Now, Square's revenue is at $1.8 billion, up 27% year over year, and their gross profits were at $783 million, up 29% year over year, and the 3-year compounded annual growth rates for this ecosystem were the same as this year's growth, which means we're absolutely doing amazing because we're keeping up those growth rates. Overall, we're seeing great trends of both businesses being able to attract customers at really cheap prices and improving their monetization going forward like crazy. That, in any business, is a recipe for success. And considering the large depreciation of the stock in recent years, I have my eyes peeled on this stock because it could be a great entry point for a lot of growth going forward. But whenever it comes to the cons of Block stock, you can't help but talk about their terrible acquisitions in recent history. With the likes of Tidal and Afterpay, you can't help but think that they had purchased these stocks on a whim and had no idea what price they were paying for them. Most notably, Afterpay was purchased for $29 billion, okay? A buy now, pay later solution for $29 billion. Whenever we actually look at the actual company's value today, it's priced at $37 billion as of the time we're recording this video. But then whenever you realize that Afterpay really only made up $150 million worth of gross profit, that only makes up 9.6% of Block's total gross profit earnings for that quarter. And we didn't even get to touch on future product developments, Bitcoin, their total addressable market, or the scary thought of stock-based compensation. If you want to hear more about Square stock, please let me know in the comments down below. Now, on to stock number 2, we have SOFI Technologies, ticker symbol SOFI. If you're new to this channel, welcome. This is a channel right now that's mainly based on talking about SOFI, as it's a very compelling stock for me at this current time, and I think that it's extremely undervalued. Jumping right into it, SOFI's business model is really made up of 3 different divisions. You have their lending division, their financial solutions, and then their technology platform. Now, for the most part, SOFI's business is just a digital online bank that allows for people to do all sorts of things. That's actually some of their biggest moats, is that they offer products for every single financial solution that you could possibly want. But whenever we look at lending, this by far makes up the biggest portion of their business at around 70% of their overall revenue. This could be for home loans, student loans, but mainly personal loans right now. Now, this could be considered a risky business, but we like to deal with this risk by dealing with the highest of worth clients. That could mean in both excellent credit scores and in average incomes of around $160,000 to $170,000 per year. And in the past 3 years, SOFI's product numbers have grown by 70%. So not only does it make up the majority of our revenue, but it's also growing like crazy. Now, for SOFI's financial services department, what you're talking about is checking accounts, investing accounts, margin options, budgeting accounts, and even credit cards. Now, there's nothing extremely exciting about one individual product within this sector, but what is exciting is the total growth and the cross-selling between those products. So unlike the stable growth of the lending department where we saw 70% growth over 3 years, the financial services have grown 21 times in the last 3 years, making this business an absolute giant in just that small period of time, and that growth is not expected to slow down at all. Lastly, we have the technology platform, which is a completely different business and one that customer-facing products do not even get to see. This is the back-end processes for other banks to be able to talk to us, where we can help them set up payment processing as well as core banking technology, meaning almost like the Shopify for online banks. Now, there are a lot of companies that do one or the other, but due to acquisitions of Galileo and Technisys, SOFI is actually the first company to be able to do both, and we bundle those prices to be able to send compelling offerings to different customers. And now, because we're actually getting out of the idea of dealing with smaller clients, now we're starting to talk with big financial institutions. We are already dealing with many large clients like Chime, Revolut, and even Robinhood for all of their credit card needs and even potentially online core banking software. In the past 3 years, SOFI's technology accounts have grown by over 490%. And although SOFI actually only has about 5 million customers on their platform, through Galileo and Technisys, we have over 125 million customers on our platform. One individual business is not why I'm excited about SOFI, but it's the conglomerate of all of these businesses and the ability to diversify and target single businesses that might have higher growths into the future. We've already been able to see their business model change whenever they were originally a student lending company, but then during COVID, that actually got shut down, so we had to pivot to personal loans. The ability to be able to switch and, let's say, start focusing on Galileo and Technisys is a massive upside to SOFI's business that I don't see in a lot of other industries. So whenever you compare these high growths to their below book value valuation right now, it's extremely compelling to own SOFI Technologies for me as an investor. On to stock number 3, we have Coinbase Global, ticker symbol COIN. Okay, please hear me out on this one. Coinbase's business model is to help transact and facilitate all sorts of crypto transactions. And considering the amount of flack that this industry has been getting, especially with the likes of FTX in this space, there really isn't a whole lot of players in this industry anymore. And Coinbase is trying to set itself up to be the one-stop shop for everything cryptocurrency. If you want to buy or sell Bitcoin, Coinbase Exchange. If you want to store your Bitcoin, Coinbase Wallet. If you want to build a new cryptocurrency, Coinbase Cloud. If you're an institution and want to be able to do all those things, but at an extremely high level with the cheapest rates, Coinbase Prime. Now, my reason for adding this to the list is the off chance that cryptocurrency makes a recovery. Originally, people thought that the implosion of FTX would actually make a big harm onto Coinbase's business model, but it actually had the opposite effect. All it did was shine light on the idea that there was two different sides to this coin. Companies that were private companies that had no idea of how to audit their own businesses and being extremely non-transparent about their business model. And then there's Coinbase, extremely public, showing that they're audited by a top 4 auditor in the world and that their balance sheet was extremely strong even though they're going through some of the harshest times that a company can face. Coinbase has chosen to go with the slow, steady, and legal growth path through this industry, and the fact that one of its biggest competitors has completely dropped off the map is nothing but a complete boost to their market share going forward. And during this crypto winter, when no one wants to touch the space, Coinbase has continued building on their platform. Coinbase now has extremely strong partnerships with the likes of Google, SS&C, and even BlackRock Aladdin, which means that their connection to over $9 trillion worth of assets under management now has a way to actually use Coinbase Prime as their primary cryptocurrency purchasing platform. In the last few quarters, they've also expanded internationally, and they've not stopped including things like subscription revenue to keep up their amount of earnings while cryptocurrency is down. But that being said, where they've crashed in certain areas and the stock price has absolutely plummeted, that growth also has an opportunity to come back. For example, in less than 10 days on the stock market, this stock has already returned over 60+% on just the idea that cryptocurrency might be coming back. In fact, it's even been growing at more than a 2x multiple at the volatility at which Bitcoin has been going up in these past couple weeks. I'm not saying Q4 is going to be any better for Coinbase, but it is a company that I'm looking at very closely. For stock number 4, we have New Holdings, ticker symbol NU. Now, where do I even get started with this one? Insanely high growth rates, even high multiples, but the largest institutional support from the biggest players in the entire world. Now, more commonly called Nubank, they're exactly that, a digital-only bank that is absolutely exploding in Latin America. Now, I guess the real magic that comes here for Nubank, and the reason why Warren Buffett is investing, is the total addressable market of Latin America that is completely untouched for financial services companies. And they're going after similar growth stories to like Cash App, where they find extremely good marketing, which leads to even better customer acquisition costs than even Cash App at $6 per person. So very similar to them, they are growing out a massive customer base and then trying to worry about monetization later down the line. And they're already hitting net profitability while still achieving amazing growth statistics that you really only see in unicorns. And that's across everything from bank accounts to credit cards to investment accounts to personal loans to business accounts to even insurance policies. They have everything that someone might need. And as all these growth rates are increasing, it's incredible to understand that their cost to actually service these customers are staying steady. I mean, truly, I do not know how they're doing it, but yet their net interest income and net interest margins are also both improving. And then couple that on top with total cash and total debt positions looking absolutely great, this growth story is unbelievable. But like I said at the start, you're gonna pay a high multiple for it as well. But that doesn't mean we're not getting a deal here, because this stock has dropped over 60% as of just going public all the way back in December of 2021, okay? And you would think there's gotta be some statistics that we can look here that might be extremely negative. But honestly, it doesn't seem to be the case. You even look at things like daily active or even monthly active users and their activity rates in between them, and they're all increasing over time, which is gonna lead to even higher monetization for their users. And then something that's really scary that maybe some people don't wanna pay attention to is how satisfied are the customers that are actually using it. Could there be a chance where the growth rates completely slow down because maybe people aren't happy with their customer service? Now, I literally have never seen this in the 6+ years of me looking at stocks, okay? Net promoter scores, okay? NPS scores measure customer experience and predict business growth. Their NPS score in all 3 geographies that they're in are a perfect 100. I have literally never seen that. That is unbelievable and just goes to a true testament to how good this product truly is in an environment that is, just primed for extreme growth. Absolutely insane. They could have more expansions into Latin American countries that are completely untapped, and they're only getting started. For stock number 5, we have PayPal, ticker symbol PYPL. Now, if you don't know PayPal's business model right now, where have you been for like the last 15 years? With over 432 million active users as of the time of recording this video, they are the biggest players on this list, maybe even the biggest fintech in the world, and yet their growth is still pretty exciting. Now, not on their active member growth. I mean, they've only saw 4% growth year over year, but then whenever we look at total payment volume over the last 3 years as a compounded annual growth rate, we're seeing rates of over 24%. And on top of that, the transactions per active user is also growing on top of that. So although we're growing our members only by 4%, the average person is absolutely spending way more time on PayPal than they ever used to. And even revenue has grown on a 3-year compounded annual growth rate of over 16%. Now, whenever we're looking at other companies on this list, that's actually starting to look like really small numbers. But the truth is, you're getting a growth stock for a value stock price. You can get a company that is demonstrating that they know what investors want right now. Free cash flow is the absolute gold that investors want to see, and PayPal knows it. Seeing $1.8 billion worth of free cash flow, which was 26% of revenue, but a 37% increase year over year. And what they're doing with that money is absolutely amazing. Now, they don't have a direct dividend, but they do have an indirect dividend through stock repurchases. Whenever they're rebuying shares, that actually takes shares off the table, which means your ownership of the company goes up, meaning that even if the growth in the company stays flat, the stock price will go up just because the amount of ownership in the company is actually increasing. That is the complete opposite of every other company that is on this list, and a true benefit to shareholders. And this doesn't even mean that growth at PayPal is even likely to slow down in the near future. PayPal is extremely observant of every company that I've said on this list, and they're doing a very similar business model. Like I said about all these other businesses, where they're building out their customer base and then going to improve monetization to build out that pyramid, PayPal has done that. They have the biggest customer base, okay? Now they're improving monetization, and it's absolutely showing. They're incredibly good at spotting upcoming trends and either designing those platforms or acquiring them. Look at the likes of Zoom, Honey, or especially Venmo. Now, if I could stop at Venmo for a second as I give a little bit of a history lesson here. Now, PayPal actually designed this peer-to-peer payment network system for sellers, and it was so good that eBay actually added it onto their platform, and they loved it. It increased their amount of sales on their platform and was a massive success. Now, eBay thought it was actually so good that they actually ended up acquiring that company themselves. They bought PayPal. They eventually took PayPal public as a separate company, and that's the company that you're seeing today. And now going back to Venmo, this is exactly what the CEO just recently recently said. What PayPal was to eBay will be what Venmo is to Amazon. We are very excited. And what he's talking about here is the partnership that Amazon and Venmo has recently made to allow not only for you to be able to send peer-to-peer payments to, your friends and family, but also to use that money that you just have on the system to also purchase things off Amazon, the largest e-commerce platform in the world. And this stock has also seen its fair share of dips, seeing a massive decrease in the valuation of its stock. So coupling that with still tons of growth on the monetization side, a massive customer base, and some of the best spending, whether it is to acquisitions or share repurchases, you have a massive fintech conglomerate here that I also think is a very safe play. But tell me which one is your favorite down in the comments down below, and I'll make more videos on that stock. But if you could, like this video and subscribe down below if you want to see more financial content just like this. Bye for now.